Good morning or good afternoon, depending on where you are viewing this from. I am Dr. Brian Schneider. I'm the CEO for Advanced Dermatology in Houston, Texas. And with me today is Anna Stevens. She is a CPA and a partner at Weaver. Weaver is a national public accounting firm, and she is the head of the healthcare division for Weaver. So we're very fortunate to have her joining us. Anna and I have worked together for many years at this point, and so we are very happy to talk to you today about strategic business planning, specifically about operational budgeting and forecasting. Very, very important components to leadership of a successful dermatology practice. So as we get into this topic, the very first question is, why is it important? Why is it important to have a strategic business plan, to develop a budget? Well, it can really be summed up in three major categories. First one is situational awareness, making sure that you have an understanding of what your current status is, your current operational status, what the pulse of the market is around you, and being aware of what your community needs are and where you fit in the community in terms of your services, your demographics, and your future growth opportunities. It's important to know that you have accurate data, that you have data integrity. You want to be able to discern the accuracy of the data within your practice. And that's important because you need that not only for your current operational status, but also to develop a baseline in order to navigate your future growth opportunities and your strategies towards those opportunities. And so that is the data that will help you make those decisions, which leads me into the second major category, being able to make an educated decision. Educated decision making comes from having strong data and data that is accurate and can help tell the story of where you're going to navigate your practice to, which is the third major category of navigating future growth. So being aware of what your current operational status is and what the market is around you, having strong, accurate data, integrity of data that you're looking at to make decisions from, and using that information and making those decisions towards steering your practice to future growth opportunities. So as we get into some of the details of those items, there are some trip-up points, some things that you need to be aware of, in particular as we talked about data integrity, the importance of that, but specifically as it relates to the practice management system. Your practice management system is an amazing tool for you. I'm talking not just the clinical EMR side, but the practice management side. It can be a repository of incredible amounts of data that is helpful towards making operational and strategic business decisions. But the importance of ensuring that the data is accurate and that there is integrity to the management of that system is significantly important. In particular, you want to make sure that your financial classes are all accounted for within that system, making sure that you are able to identify all of your payer types, and that you have every opportunity to front load your contract terms, meaning that all of the negotiated rates for each of your contracts are loaded into the system so that they are linked to your patient accounts relative to their type of payer. So when somebody comes in, when you have a patient that comes in and they are checking out or checking in, depending on how your practice is designed, when their charges are entered into the system, it automatically calculates the allowable rate based on the contract terms, which helps your front desk person to know what is to be collected in terms of copay or deductible. It also is helpful in reconciling your EOBs to the payments that are received. One of the big no-nos in any practice is to post per the EOB. You post per the contract. There are many claims that are processed incorrectly at the payer's level, and you need to make sure that your system is designed but with front-loaded contract terms in order to recognize or capture those errors at the time of posting. The other thing that's important to look for in your practice management system are your credit balances and ensuring that you have true credit balances and not manufactured credit balances in the system. So what do I mean by manufactured credits? There have been many practices where I have consulted with where I have seen the credit balances not managed as well as they should, meaning that what is the root cause of a credit balance? Are we consistently over collecting, and if so, why? What are the root causes for that? Because you do not want credit balances in your account. You're required to refund credit balances. It's a matter of law, and managing this is extremely important because it is a liability on your balance sheet, and it's something that you need to be aware of. There have also been practices where I've seen credit balances and then a pseudo charge that's entered to bring that account to zero as opposed to managing that credit balance as it should. Those ought to be red flags. You need to manage your credit balances appropriately and look to the root cause of why they exist and make sure that you have a process in place at least on a monthly level to adjudicate those credit balances appropriately. The other thing is reconciliation of charges and payments. It's a topic that Anna is going to get into more detail on here in a minute. But making sure that you have a good process of reconciliation to look at what your charges are and what your payments are, and reconciling your payments to the bank, reconciling payments to the patient accounting system and your accounting system all need to take place. The other thing that also Anna is going to talk in more detail about is inventory. Inventory management is extremely important, and so the data within your system as it relates to inventory is only as good as your reconciliation processes are managed. But it has a big impact on supply expenses and an indication also on how you navigate your budgeting process relative to your expense items, which we'll get into later on. The other areas of data integrity that are important for your practice management system relate to your referral sources. It's important to have an accurate capture of where your patients are coming from, whether it is another physician, whether it's a specific Google search that was done or internet search, whether it was a friend and who was it, a family. The more specific data you can get, the more helpful it is towards your marketing strategies. And then also, lastly, the data on your actual appointments, how your scheduling module is utilized and how you're accounting for your scheduled patients in terms of confirmed appointments, no-shows, cancellations. Ensuring that those are true and right and accurate will definitely have an impact as you look to create your budget off of your expected patient volume, as well as the type of call traffic that you're having. What is your conversion rate? What is your no-show percentage? So you can calculate all of that into your budget. And with that, I'm going to turn this now over to Anna, who's going to talk to you about proficiency levels for financial system competencies. Anna?
Thanks, Brian. I appreciate you giving us that overview. And kind of what I'm going to talk about is some specific areas in a much more detailed level before we actually get into the budget, because I think it's really important that you make sure you have a good baseline of information, because your budget is really built off historical trends, as we're going to talk about here in a minute. But that's only as good, as Brian has mentioned several times, as the data is there, right? Garbage in, garbage out kind of methodology. So we want to make sure we have some good processes and systems in place to get our data set prior to jumping into the budget. Because if you jump into the budget ahead of this, then your budget's going to be worthless as well. So let's really talk about some of these different areas in some more detail. For example, accounts payable and invoicing. Those two go together. And so when I think about accounts payable and invoicing, what I'm talking about there really is you want to make sure that you're getting the invoices in the time period that they were at, that the service actually happened, so that the expense was incurred. So, for example, there are definitely a lot of vendors that tend to send their invoices late, 2 to 3 months later. And I see a lot of times where practices will put the invoice in whenever they receive it. And so, and it is challenging, no doubt, to sometimes collect those invoices in a timely fashion, but it's extremely important that you set up processes to receive those as timely as you can. So one thing that I will mention is a lot of times practices will implement a central email address, for example, so that invoices are sent to the central email address, and they, so the vendor knows, hey, if I just send it to this AP at Advanced Dermatology, I know that the AP clerk, whoever that is on the other side, is going to get it, and then it doesn't get lost on someone's desk that doesn't turn in. So that makes it a little bit more streamlined. The other thing that you can do is the accounting team can, post an accrual for those expenses. So you're not, you don't see these large swings. So if you know that I'm going to have, rent every single month, or I'm going to have, or I know that we did a big marketing campaign, so I have a bunch of expense there. I go ahead and accrue it if I can't hunt down the actual invoice. The other thing I would recommend is if you have a large non-recurring expense, that you actually call the vendor, because a lot of times they have the invoice. Maybe they just haven't sent it in the mail, or maybe it has been sent in the mail, but it just hasn't made it to the accountant's desk. So you can certainly call the vendor and ask them if they can email you a copy of the invoice, so that you can go ahead and get it entered into your system, so that you're getting the expense in the proper month. And why does that matter? Because your budget, like I said, is built off of that historical. So if we know that we do a lot of expense, we have a lot of expense in January, we want to make sure that that's reflected in our actual financial statements, so that when we prepare our budget, we get the same type of expense ratio in January, or whatever that high expense month or low expense month is, so that it's properly reflected. And when we're doing budget to actual, which we're going to talk about here in a little while, is that then we can actually project and expect those dips and rises in expenses, and it's not something that's coming out of nowhere. The other side of that is, and the flip side of that is accounts receivable and posting. So this is the revenue side of it, and you want to make sure that your charges are getting entered in again in the month that they were incurred. So you want to make sure you're leaving that accounts receivable system open for whatever amount of days after the month end, to capture any late charges or anything that might flow through that needs to be posted to the prior month, to make sure you're capturing all the services that were performed in that month. Same methodology as the accounts payable. We want to make sure we're capturing the actual services that were performed in that month, so that when you're budgeting for the future months, you can actually make sure your budget matches the services that are performed. Again, I see this all the time where late charges happen. It's going to happen. So don't think, oh, I have a great system in place, there's not going to be any late charges, I always capture them when it happens. That's just not an accurate statement. You might have a small amount of late charges, but again, there are always charges that come in after the fact. Or you have a month that ends on a holiday. For example, May 31st is Memorial Day this year. I mean, there's going to be charges that are going to lag because people being out on vacation, etc. So you need to make sure that that gets in. And that's going to help, again, something else to remember is accounts receivable and accounts payable are typically modules that flow into the financial statements directly. And accounts payable definitely is. And most financial systems that are creating your financial statements have an AP module where the invoices enter directly into the system, and then behind the scenes creates a journal entry to the financial statements. So again, extremely important that those invoices are entered in a timely fashion, so that journal entry can happen on the back side. Now for AR and accounts receivable and revenue, it just depends on if your EMR is integrated into your financial system. I see about 75% are not, and about 25% are. So you likely aren't, and that's okay. But regardless, the person that's posting the journal entry into the financial system is still using a report out of a different module. So the report that they're using to post the journal entry is only as good as the module has a proper cutoff. So if you send their accountant a report out of the EMR that didn't have a proper cutoff, they're going to post something that's not all inclusive of the charges that were incurred. So again, making sure you're leaving that EMR system open, just, however many days makes sense for your practice, but making sure your staff are getting those charges in within 1, 2, 3. I'll tell you, when I was on the practice side, we left it open 3 days. We required all of our locations to make sure that they got their charges in within 3 days, and that was the cutoff. And so if you can develop that process ahead of time, that's usually a sufficient amount of time, regardless if people are on vacation or a holiday or whatever. 3 days usually gives enough time for people to get their late charges in. So again, make sure you got a process in place for proper cutoff for AP and AR, so that you can see what actually happened in that month. And the next piece of this, and Brian alluded to this a little bit, but I want to go into more detail with it, is inventory management. So why does inventory management matter? Well, first of all, inventory management is really making sure that you are getting your supplies in line with what you're actually doing. So you want to make sure that you're setting par levels for your inventory. So what do I mean by that? So your inventory should be set at a level of what you expect to use within the next month, really, and what you're going to turn over. And so you should be able to look at your history and see what your heavy months are. I mean, maybe your practice doesn't have a heavy month, but most practices usually have a heavy, 1 or 2, 3, maybe 3 months out of the year that they tend to see a significant more amount of patients, whether it's cosmetic or medical, and for a variety of reasons. For example, December might be a heavy medical month because people are using up all their they want to get their insurance used up because it's going to start over in January and they're going to have a large deductible. Or maybe you have, June's a heavy cosmetic month because you're going into the summer and people are going on vacation, et cetera, et cetera. So you want to make sure that your supplies are reflecting that and staying at that par level, and so that you can expect an increase in expense in June or December or whatever the heavy month is for you, and you don't have these large ups and downs because you didn't get your inventory managed well. And I see that a lot. You may think that that's simple information, but there's an art to managing your inventory, and it really takes a minute to stop and go back and look at what do I expect to do, what have I historically done, and then managing your purchases to match what you expect or you've historically done. And then because you're going to budget, again, if we're going to have an increase in revenue in June, if we expect an increase in services, so we're going to have an increase in revenue, but we're also going to have an increase in expense. So you want that to be in line, right? And so if you don't manage your inventory well, you're going to have this large expense in July probably because you got to catch up for all those things that you sold in June, instead of matching your expense with your revenue because you purchased in June because you knew you were going to increase your, or you projected to increase your services in that month. So that's why it's really important, because then, when you're talking about your budget to actual variances, we didn't have a huge variance in June because we budgeted for an increase in expense and we had an increase in expense. Or we didn't manage our inventory and now we have a huge increase in July and we got to explain because we didn't manage our inventory. And so I think it's really important that you take a minute to get that in line, and it'll really help you when you're looking at your financial statements. Yeah, I mean, I've sat in tons of board meetings and they're like, what happened here? Well, we just didn't manage our inventory well. Not like anything out of the norm happened. And so that's never a fun answer. The answer is more fun when you can say, well, the expense went up because we blew our revenue budget out of the water, so we blew our expense budget out of the water. That's a more fun answer to have. So you want to have that answer versus we just didn't manage our inventory. And so the last thing I want to talk about, probably the most forgotten, but the most important, and it's this reconciliation. And before I get into the detailed reconciliations that need to be performed, I want to mention that this is something that I see get forgotten because it's not actually required to keep operations going. And so people tend to think, well, if I have to do one thing, or I have to give up one thing, I'll give up the reconciliation because I got to make sure my patients come in the door and I got to do this. But the problem that happens is you very quickly, when you stop reconciling, things get out of hand and it's really hard to go back and undo. So I would recommend, and something I did when I was on the practice side, was I would actually just set a day and I would say reconciliations have to be done by this day. And that gave me some grace that if some emergency came up that I could manage that, but then the next day, gosh, I better get on reconciliations because I had a deadline that they had to be done by. So that's what I would recommend, is you put a day that says I got to have these reconciliations done by this day, so that you can handle emergencies as they come up, but you don't forget to do them because they're extremely important. And so the different types of reconciliations, these are some of the more common ones that just absolutely must get done. It's not a bad idea to reconcile pretty much anything that has activity flowing through it, but these really must get done every single month, and some of these more often than monthly. But the bank reconciliation is one that I typically see happening the most frequently. I mean, if you go talk to any company, if they're going to do any reconciliation, it's probably going to be the bank reconciliation, which makes sense. It's your cash. You want to kind of keep tabs on what's happening to your cash. But I will tell you, I actually have a client that they haven't reconciled their bank account in 2 years. So I didn't know that there was any companies that didn't reconcile their bank, but apparently there are. So if you don't reconcile your bank, you should do that immediately, so that you at least know where your cash is. But that's the most common reconciliation that's done. Just shows you, what the cash is in the bank, the checks that you've written that have not cleared the bank, and then if you know of any deposits that are coming in that have not cleared the bank as well, and that gets you back to the amount that's on your financial statements. So pretty simple, but it's really important so that if there is anything out there, hey, I have all these checks that I've written that haven't cleared the bank. I need to be careful if I'm going to write any more because I might put myself in a negative cash position, and obviously that's not good unless you have some deposits that are going to come in pretty quickly to cover that. So super important, but also pretty common. The next three things, charges, payments, and billing, all kind of go together. So I'm going to talk about them as one reconciliation, although it's a pretty voluminous reconciliation that can usually consist of several tabs and several pieces to it. But it's really reconciling the charges, the payments, and what's going through your practice management system, and all the way from when the patient walked in and you started the procedure to the money hitting the bank. Like, how does that reconcile all the way through? Because what ends up on your financial statements is the money that went into the bank, but how does that reconcile back to the charges that are being done? I mean, it's absolutely critical that you make sure that you're reconciling that all the way through to make sure you're not leaving money on the table, or that money's not just disappearing, or charges aren't being billed. So how are you making sure you're capturing all that piece? And I'll tell you, this takes time. It is usually one person's full-time job, depending on how large your practice is, but it certainly needs to be being done, regardless if it's somebody's full-time job. But there should be a person that this is, their, for lack of better words, that this is their project, and they are going to take this and make sure this happens. And so I will tell you, we go in and we assess. I'm an audit partner, an assurance partner, and so for my audit clients, we go in and assess internal controls for my clients. And this is one where the first one off the bat, I'll ask them, do you have a reconciliation for your charges to your payments? And if they say no, almost guaranteed a hands down a material weakness. And what I mean by that is that's one of the largest areas that you could be leaving cash on the table. Fraud could be happening because there's no trace of when the patient walked in the door to when the payment came into the bank. And if somebody's going to create an issue, it's going to be in that area because there's just so much activity that flows through it. And this I would recommend doing on a daily basis. Banks usually get done on a monthly basis because there's just enough activity that you can actually still reconcile it on a monthly basis. Charges, payments, billings need to be done on a daily basis. You're seeing lots and lots of patients. Lots of things can happen. There's lots of different CPT codes that could be being charged. There's lots of different human errors that could be happening. There's lots of different types of payments that could be being made. Insurance, credit cards, all different kinds of things that could be running through. There's just so many data entry points that you need to be doing this on a daily basis to make sure you're capturing every piece of the information correctly. And so you're obviously grabbing that, and depends on if you still have clinicians that are operating on paper, or if you have some of the clinicians that are operating fully electronic. You want to, at least if they're operating some on paper, you want to grab that paper, make sure that first of all, reconciles to what got into the EMR, the electronic system, because I can tell you your bills are generated off of what's in the EMR. And if there's a disconnect between the paper and what's in the EMR, your bill is going to be wrong right off the bat. So you need to make sure that the paper matches the EMR. If you don't have paper at all, then great, you can just start with the EMR, because what's in the system is what's going to get billed. So then you want to make sure that the bill actually reflects what got charged to the account. Did we actually bill the CPT codes that the clinician put in the system for the things that they performed for the patient? And then, so now we've billed it, but then we need to do a reconciliation to make sure that, one, the bill gets processed and adjudicated and it doesn't just sit there forever with the insurance company or whatever the case may be. Now that it's gotten adjudicated, as Brian mentioned, you do not want to post per the EOB. The EOB is a great starting point, but the EOB, they process millions of these records, and they're just flowing through a system, literally. I mean, there is no person that's looking at these claims. It's flowing through a system, and because systems are not perfect, lots and lots of claims are adjudicated incorrectly. And so you need someone to review that payment poster, to review per the contract, was the EOB adjudicated correctly? And if it was, great, you post it and you move to the next step. If it wasn't, then we need to go through the proper processes of appeal or whatever that might look like to get it adjudicated correctly. So now we're going to assume that it's adjudicated correctly. We've got it posted in the system, but what happened to the cash? I mean, that's just posting in the system, but did the cash actually get deposited in the bank? And the tricky part here is 9 times out of 10, and probably 9.9 times out of 10, the cash that hits the bank is a lump sum payment of a bunch of different claims. And so it never usually matches one person's claim unless they just happen to process one claim. But as again, United Healthcare, Aetna, they're processing a lot of claims that come through in a lump sum. So you need to make sure that the amount that hit the bank actually matches the EOBs and the payments that were posted, assuming it's adjudicated correctly, were posted to the system. And so now, assuming that's great, then we can check the box to say, yes, the cash came in the bank, it matched the matched the EOB. The EOB was adjudicated correctly, which matched the charges, which matched what the clinician did. We've gone all the way through. But that's one claim. Think about all the claims that you do. That is a long process, so it must be being done on a daily basis. There's no way by the end of the month you're going to be able to figure all that out and unwind that. Unless you just are a brand new startup and you only have 10 claims that come through in the month. But I can tell you, if you're of any size, that needs to be being done on a daily basis, and you need someone to own the process all the way through. I'm not saying that person needs to be posting to the financial statements, or needs to be posting each piece of it, but they need to be able to see each piece, and they need to reconcile each piece through to make sure that it's happening. So certainly important. Again, there are other reconciliations that you could be doing. You could be reconciling each of the financial statement line items. I recommend that. I do that for my clients that I help with their financial statements. But I mean, these absolutely must be done so that you can make sure that your cash is accounted for and that your charges are following all the way through to the billing, the cash that comes in the bank. So with that, so now we're assuming our data is good. We're all good. We all got our baseline. So now we're going to go into actually building the budget. So let's flip over to the next slide if you don't mind, Brian. All right, so let's look at building the budget. So we're going to go to the next slide. Okay, so there's lots of different ways you could work on building a budget, but Brian and I, we broke it down to kind of 4 different categories, and he's going to cover the middle 2. But before we get into revenue, we're going to look at starting to build a budget. So the way that I typically start to build a budget is I build a trend analysis. So we talked about getting our data in order, and it's super important that the data is in order, the historical data is in order, because that's where your trend analysis is going to be built off of. And so you're going to take a look at what you've historically done, and then you're going to build a kind of just a general baseline that you're going to adjust for other future information that may change for the next fiscal year. So the first thing on the trend analysis is averages, right? So we're just take an average of the expense. Well, you can, but the problem with averages is that averages don't necessarily account for, well, they just don't account for, ebbs and flows of things that are that can happen. So I would caution you, if you're going to use an average, to only use it if it's an educated average that you're using. So a better you know baseline would be to look at control charts, and we're gonna take a look, and I'll show you what a control chart actually looks like. So this is an example control chart, and you can do control charts for all different kinds of things, but this just is a control chart for admissions, for example. And so you're creating a target amount. So on this, the target's 362, but then you want to build an upper control limit, a UCL, USL, whatever you want to call it, and a lower control limit, LCL. And it's usually 1 to 2 standard deviations above and below your target line. And so basically an upper control limit and a lower control limit says, what am I going to be okay with if we're varying outside of that target range? And so that's where you're going to decide, I'm okay with a variance of 1 standard deviation, or I'm okay with a variance of 2 standard deviations. Whatever you're okay with, that's where you're going to set your upper and your lower control limit. And then anything outside of those 1 to 2 standard deviations, you're going to actually dig into and figure out what happened. So this is a great control chart because you can see there is a period of time where the admissions dropped below or outside of that lower control limit, and you can see it's explained on here as the norovirus outbreak. So, someone said, gosh, we're below the lower control limit, so let me go dig in and figure out what actually happened, and then we can go in and see and address that. So that's what a control chart does. It kind of gives you can see there's stuff all over the place, and it's going to be ups and downs, but nothing was outside of that upper or that lower control limit except for that one period of time. So everything else we can live with and we're okay with. We don't really necessarily have to do a bunch of deep dive into. So that's a control chart. We'll flick back. And then clinical statistics for expense forecasting, extremely important when you're looking at supplies. So when you're building your certain expense line items, you're going to want to build them as a based upon the clinical statistics that you have built in for that same month. So what I mean by that is when Brian talks about patient volume and reimbursement analysis, but mainly patient volume, you're going to want to make sure your supplies are moving in line with that patient volume. So if you expect it to be higher in January or December or whatever month you expect it to be higher in, then you would expect the expenses to flow directly with that. And that could be supplies, it could be staffing, it could be a variety of different expense line items that flow directly in relationship with the revenue that you have. So you're going to want to make sure you have those clinical statistics in line so that you can make sure you're budgeting your expenses on that. And with that, I'm going to let Brian talk about volume and reimbursement analysis.
Great, thanks, Anna. Yeah, so as you look to build your budget, remember you can use historical data as a baseline, but you're looking ahead. So it's not just taking last year's information and then applying it to next year as a one-for-one. You have to look at what your conditions are that are potentially going to change. For instance, you may have a new physician that's coming in, maybe replacing one that's leaving, or you're adding a new physician to the practice overall. And this physician may do more cosmetic than clinical than either the one that's being replaced, or that you're going to now have a new physician that's going to take on an additional cosmetic patient load. And so being aware of what your volume is as it relates to clinical versus cosmetic versus other, meaning maybe you're adding Mohs or you already have Mohs, and you're going to project that into your budget, that's going to be important. As it relates to clinical, it's going to, as you break that out, looking at your E&M breakout on your coding to see how your physicians are coding and billing out based on how many new patients they have, based on how many established patients they have, and then also itemizing a list out of the different procedures that are done by volume by payer is also going to be important in determining your budget build. As it relates to cosmetic, looking at what your cosmetic volume has been historically, looking at your provider, your physician, and your PA, nurse practitioner makeup, and what you are projecting them to do in the forthcoming year. There are a number of practices that may have new or improved equipment, whether it's laser hair removal or IPL, or perhaps you're adding resurfix or some other type of laser or some other type of cosmetic service. Make sure you're going to capture that in your budget build and what your anticipated patient volume and revenue is going to be from that. In addition to the patient volume analysis, it is important to, not only for budgeting, but just for operations, it is important to know what your return rate is for your physicians, meaning your new to established patient ratio. Are the patients that are coming in as new patients to a physician ever returning? Or do you have a different issue there that you need to maybe look into? But as it relates to the volume in terms of your budget build to reimbursement analysis, this gets back to what we talked a little bit earlier, which is really having a good idea of your payer mix. Understanding what percent of your practice is comprised of Medicare patients, Blue Cross, and how many are PPO, how many are HMO, what your typical reimbursement rates are. I typically like to view it in terms as a percentage of Medicare. So if you look at what your contracts are and calculate it, if it's not already negotiated in those terms, what are your rates for the types of services that you just ran on your volume analysis as it relates to Medicare? Are you at 80% of Medicare, 90, 100%, 110, 120? And knowing, having an understanding of not only what your payer mix is, but also how your patient volume relates to that payer mix. That's going to help in determining future contract negotiations as well. But it also, that volume plus your reimbursement analysis is going to give you what you need to help you get an idea of what you're expecting by way of volume and relative corresponding reimbursement as you build your budget. And with that, our last item on this piece of our prelude to the budget build is environmental condition change, which Anna's going to talk about.
Yeah, so the last thing you need to do, so now you've got your baseline, your historical data, you've kind of got your revenue set based upon your projected volumes and your payer contracts, and now you need to take a look from your expense side and say, is there anything that is going to change in the next fiscal year that is different than history? So do you have new service contracts? Is your rent going up based upon the new rent agreement? Are you going to purchase new equipment? Is your vendor increasing your supply cost for medical, cosmetic, office supplies? So are there any increases in expenses that you're expecting that did not flow through in the historical financial statements? And you want to make sure those are incorporated into the budget so that when you're looking at budget to actual, you have those new numbers built in already. So with that, Brian's going to walk you through an actual a budget that you can take a look at. And while he's getting there, I just want to let you know that you can actually, in the chat box, we'll send you a link to, or a download that you can actually download this Excel file that we're going to take a look at, so that you can use it. Again, obviously, needs to be adjusted to your situation, but it's a good starting point.
Okay, so like Anna said, this spreadsheet should be available in the chat for you to download. It's just one of many tools that are available to you out there, or one that you may want to use, or you may use something different. That's fine. This is just an example of how to build a budget. Get over to it. Okay, so here's the income statement. You're going to see tabs all along the bottom here. And this first one here, the income statement, this is very important that I point this out. This is the one sheet that you do not enter anything directly into. And the reason is because all of these other sheets on the bottom here flow into this sheet. And you can see all the categories here from revenue, patient revenue, other income, the salaries and benefits for operational staff, any clinical supplies leads to your operating income. Your expenses, you will have to determine what goes here, and you'll find this in your expense items, which is SG&A other over here. But you'll determine what each of these categories are, and I'll show you that in just a second. But here's some examples. And then your interest income or expense as other income, which leads to your net income percentage, and your EBITDA. So let's see if I can move this over real quick. Right, so the first tab is revenues, and here is where you can insert additional rows, and you'll need to just copy over the formulas that are in here. But here I've already populated, I may want to list Medicare HMO, what a Medicare supplement is. And for January, let's say we got $50,000 in Medicare. Perhaps you got 20,000, and just making these numbers up, in Medicare HMO, and maybe you got 10,000 in a Medicare supplement. You see right now here we need to, I think I'd type that earlier. In any event, oh, I see. So that's taking that total there. So for Blue Cross, perhaps we had $100,000 in Blue Cross. We had 50,000 in Blue Cross HMO. We didn't have any in the point of service. And Aetna, well, you get the idea. We're down here to about $230,000. If we go back over to the income statement, we'll do that real quick. Move that. You can see that it auto-populated that into the patient revenue component. So you would just go through each of your sources of revenue by payer type as one suggestion. You can also do it a different way. You can just put all clinical, all cosmetic, and have it much more of a macro type number. It's however detailed you want to be within that. And then your other revenue could be PPP loan, provider relief, which came from Department of Health and Human Services, I believe. And as an example from something that we experienced last year, if you have any other type of revenue that you have coming in, you would record it there. Salaries and benefits, you would here have any of your staff salaries, operational staff. You can list it by medical assistant, front desk. You may have maybe you have a nurse on your staff, so you can include all of that there. That would populate over to the other side. As a matter of fact, here we could just put one in here. We want to do, let's say, a medical assistant. And we want to put in here that this person is, for the month, let's just say they get $3,500, let's just say. $3,500 a month, calculates it out across, and you can see how this is going to tie back to our income statement, as now their salary is in there. So you would add all of your staff in there, and it will populate into your income statement. Same item goes for your expense items. And so again, you'll need to determine what each of your categories are for expenses relative to your practice. And the same principle applies. Whatever you enter in here, that total on this line is going to populate into your income statement. So I think it's fairly self-explanatory. These are each of your working sheets. These are your expenses. This is going to be your corporate allocation. This is going to be more of your staff, your clinical staff, and then your other revenues and your revenues are all going to tie back to your income statement right here. So this should help you as a tool for creating your budget. All right, well, that's a brief budget template overview, and now I'm going to turn it back over to Anna, who's going to talk about deploying your budget.
Okay, so now we got the budget built. What do we do with it? So it's, that's a big process too. Once you've got it built, it's really important that you make sure you deploy it properly. The first step on this slide is the location budget. Again, if you have multiple locations, extremely important that you're doing your budgets by location. If you only have one location, obviously that's you don't need to do that, but make sure your budget is done by location so that each practice manager for each location has their own budget that they're looking at. So then you want to so you've got the location budget, so then you want to develop these variance analysis, right? So you've been talking about making sure that we've set our budget, first of all, is based upon any sort of good data, because now we're going to take our actual data that actually happened and bump it up against our budget that we budgeted for the month, and we're going to have our practice managers take a look at it and explain the variances. So do we want to be explaining every dollar variance? No, that's way too much time, not going to help anyone. So you want to set a threshold that makes sense. So maybe it's a 2 to 5% variance threshold. You can also do a dollar threshold. I like to look at them together. I usually set a dollar and a variance threshold. So whatever makes sense for your organization that's going to capture the variances that are going to help you make better decisions. So we don't want to look at variances and explain them if they're not going to help you make a better decision. So the point of the budget is to take a look at the things that have, changed and outside of what we expected, and help us figure out what we did right so we can redo it again, or what we did wrong so we can fix it in the future. So the budget is really a tool to help us when we're making decisions. And so that's why we want to make sure our variance threshold that we set is actually going to help you make better decisions. So if it's too low, it's just going to be a waste of people's time. If it's too high, then we're missing some of those areas that we could actually be making changes in. So this threshold, you probably will not hit the nail on the head the first time you set it. I would set it at what you think it should be, and then I would continue to monitor it. And you'll probably have to change that based upon if you feel like your staff are spending too much time on things that don't make a difference, or if you're missing key areas that really should be being explained. So, that's 2 to 5% is usually what I see, but again, take a look at your specific practice and make sure you're setting that variance threshold, relative to your practice. And then understanding the why, again, kind of goes hand in hand with the next line on it. Says actual budget decision making. Again, the whole purpose of the budget is to help us make better decisions. So you want to understand why things happen, not just, oh, there was $100 difference, or there was a 2% difference. Okay, yes, but why? Why did it change? Did we have an increase in revenue, therefore we had an increase in expenses? We blew the revenue budget out of the water, so therefore our expenses are way up. Okay, that's great. We understand why it happened. It's not helpful to just say that expenses were up 2%. Well, we can see that on a piece of paper, but why were they up? Did we not manage inventory well? Did we have a bunch of extra patients that we weren't expecting? Did a pandemic happen? I mean, what happened that caused the variance to occur? And then, again, that flows very nicely into saying, okay, now we know why it happened. Did we like the variance? Did we like the why? If yes, how can we repeat it? If we did not like the why, how can we make sure it doesn't happen again? So that's the purpose of the budget. So making sure that you're explaining that purpose to whoever is doing the variance analysis is extremely important as well. So they understand why you're trying to understand the variance, so that they get that key information. So that's really the point of the budget. That can be an extremely powerful tool if used properly. It can be extremely a big headache if it's not used properly. So I think deploying it is almost as important as building it. And when I say deploying it, I mean deploying it properly is almost as important as building it properly. So any other comments, Brian?
Yeah, I think we're looking forward to being live with you, where we will entertain questions and further discussion points at that time. So we look forward to seeing you then. Thank you.
Thank you.